A surprisingly weak first quarter economic report is rattling Wall Street this morning, with the U.S. GDP having grown just 1.6% instead of the 2.5% forecasters had been expecting. Meanwhile, inflation, as measured by personal consumption expenditures, came in at 3.7%, excluding food and energy, hotter than the 3.4% forecast. I'm Rosemary Miller, and here to discuss the report with us today is Young-Yu Ma, the Chief Investment Officer of BMO Wealth Management. Thank you so much for joining me today, Young-Yu.
Great to be here. Thank you.
So, is this report really as bad as it looks? It seems like consumers are still spending, but international trade and reduced inventory growth subtracted from the number. What can you tell us?
Yeah, if you look under the hood of the GDP report, it's actually quite healthy. You did have consumer spending hold up well. You had business spending hold up well also. And those areas that detracted from GDP growth, inventories and trade, those tend to be quite volatile. So on a quarter to quarter basis, sometimes those add a lot or contribute a lot. Those tend to wash out over the course of a year. So really, when we look at what we think are going to be the drivers going forward, it's the business spending and consumer spending that have held up well. And we think they'll continue to hold up well throughout the rest of the year. So we're not too concerned about today's report because some of the underlying fundamentals still look pretty good.
Mhm. So, everybody's wondering what the Federal Reserve's next move on interest rates will be. What does the hot inflation number today mean for the outlook for rate cuts this year?
The Fed is going to be on hold for a while. I think there's a lot of skepticism among Fed members about uh, if interest rate cuts are even necessary at all this year. So I think we're going to need to see a string of inflation data for multiple months before the Fed would get comfortable with the idea of cutting rates. So I think these higher rates we've had recently are with us for some time to stay. Perhaps we'll get one interest rate cut this year, but I think that's probably the most we would get.
So, when do you think that one interest rate cut will be?
If we get it, it would probably be either this September or December. But again, I think we're going to need a string of favorable inflation data before the Fed is comfortable. So that favorable inflation data would have to start pretty soon here, if not next month, certainly by the summer, because it's not going to be just 1 or 2 months of good data that gives the Fed confidence. It's going to be probably 3 or 4 months. So it'd have to start soon if we're going to get a rate cut in September. Otherwise, it would probably be pushed off until either December or even 2025.
Well, Young You, it looks like consumer spending is still strong, and initial unemployment claims in the latest week were lower than expected. What do you see there?
The labor market continues to be healthy. That's been a bedrock of the economy and what's provided stability and allowed us to have the soft landing. And we see that in the initial unemployment claims that are really at rock bottom levels right now. So we think the labor market will continue to be healthy. That will continue to support consumer spending. We have modest wage growth that is above inflation. Even with the higher inflation prints we've had, wage growth is still running around that same level. So we think the consumer will hold up fine here and will help us to actually achieve what we think in the second half of the year will be accelerating growth based on corporate spending improving. So we see the fundamentals still holding in there and consumers being a foundation of that.
So, were there any other bright spots that you saw in this report?
I don't know about bright spots. I think the main thing about the report is that there weren't areas of concern. And perhaps one thing we could point to is business spending in the GDP report that held up quite well. We do think that over the past year, have been relatively cautious in terms of their spending because they've been concerned about a recession or an economic slowdown. And now that that has not materialized, I think the businesses are starting to shift to expansion mode, and that spending should really start to accelerate in the coming quarters. So it's not necessarily a bright spot in this report, but we do think it will be a noticeable bright spot in the coming reports later this year.
Well, the stock and bond markets, they clearly didn't like today's news, but how much of that is just a knee-jerk reaction?
There's part of it that's a knee-jerk reaction. Certainly, inflation concerns are prominent now. Some of the earnings reports that came out last night were not favorable as well. So I think we've had a big run over the past 5 months and a big run to start this year as well. And some of what's taken place over the past couple of weeks is really just a pullback from that, given that from those big run ups, given that the Fed is now on hold and also inflation is not on the downward trajectory that the market was hoping for and anticipating. And it looks like it's going to be more of a bumpy path. But we do think the path of inflation is still downward throughout the rest of the year. It's just not a straight line. So I think the market is fine to pull back a bit, but we don't think there's going to be a major downturn or an overall shift in the trend. We think it's just a pullback from some of the run up that we've had recently.
How do you think long-term investors should react to this data?
I don't think long-term investors should react too much. I think if long-term investors have their plan that they've laid out and they're comfortable with their risk profile, we do think that this year is going to still be a favorable one, and we don't think that these near-term pullbacks are worth repositioning the portfolio for. If there were a greater pullback in the economic fundamentals and trajectory and outlook remained healthy as we think it will, that could be an actual opportunity to deploy more capital. We think now is probably stay the course and see how some of the near term develops. But there could be opportunities that arise if this pullback does actually go a bit further.
Well, Young Yu, is there anything else on your radar regarding today's GDP report that you believe should be on ours?
I think that covers it. I wouldn't put too much emphasis on one quarter's GDP report. It is a backward looking data point. And when we look at some of the forward looking measures, both including the labor force, such as the initial unemployment claims, or if we look at other measures of CEO confidence and expected expenditures in the economy, we do think that those continue to look favorable. So even though today's report was on the weak side, we think that the coming data and the coming growth trajectory for the U.S. economy is actually quite healthy.
Well, thank you so much for joining me today.